JPMorgan Chase controls more than $3 trillion in assets, moves enormous volumes through global payment systems every single day, underwrites corporate debt, finances governments, safeguards retirement accounts, and holds checking and savings deposits for tens of millions of people. It is not just a bank where you keep your debit card. It is a structural pillar of the American and global financial system. That scale is exactly why asking the question feels so unsettling. What would actually happen if an institution that large collapsed tomorrow morning, and what would it mean for your personal bank balance? The fear feels plausible because we have recent memory of chaos. In 2023, when Silicon Valley Bank collapsed, headlines spread faster than regulators could respond. Depositors rushed to withdraw funds, social media amplified panic, and within hours a multi-billion-dollar institution was effectively insolvent due to a classic bank run. That event reminded everyone that banks are not vaults storing your exact cash. They are intermediaries that lend deposits out, invest them, and rely on confidence to function. Once confidence cracks, liquidity evaporates quickly. However, understanding what would happen to your money at an institution like JPMorgan Chase requires separating emotional reaction from regulatory reality. There is a defined legal and procedural framework for bank failures in the United States, and it activates immediately when regulators determine a bank can no longer meet its obligations. The system is designed specifically to prevent disorderly collapse from wiping out ordinary depositors. To understand the mechanics, we first need to clarify why banks fail in the first place. Broadly speaking, there are two primary failure modes: insolvency and liquidity crisis. Insolvency means the bank's assets are worth less than its liabilities, often because loans went bad or investments declined sharply in value. Liquidity crisis, on the other hand, happens when a bank technically has enough assets, but cannot quickly convert them to cash when too many depositors demand withdrawals at the same time. The Silicon Valley Bank situation was largely a liquidity crisis triggered by rapid withdrawals and unrealized losses on long-term bonds. In both cases, the immediate danger is not just financial weakness but the speed at which panic spreads. If a megabank like JPMorgan were to approach failure, regulators would not simply wait until it imploded. Large banks are under continuous supervision by the Federal Reserve, the Office of the Comptroller of the Currency, and other regulatory bodies. They undergo stress tests designed to simulate extreme economic shocks, including recessions, market crashes, and rapid withdrawal scenarios. These tests exist precisely because of the too-big-to-fail problem that became painfully obvious during the 2008 financial crisis. If, despite all safeguards, JPMorgan were declared unable to meet its obligations, the next actor to enter the scene would be the Federal Deposit Insurance Corporation, commonly known as the FDIC. The FDIC does not allow banks to simply shut their doors and leave depositors stranded. Instead, regulators typically close the institution after business hours on a Friday to prevent panic during operating hours. Over the weekend, the FDIC either arranges a purchase by another bank or establishes a temporary bridge bank to maintain continuity of operations. For ordinary depositors with balances under $250,000 per depositor, per insured bank, per ownership category, the outcome is straightforward. Those deposits are insured by the FDIC, meaning the government guarantees repayment up to that limit. In most historical cases, depositors regain full access to insured funds by the next business day, often without needing to file claims or take special action. Debit cards work, checks clear, direct deposits resume, and from the customer's perspective, the transition may feel surprisingly uneventful. The complexity begins when deposits exceed the $250,000 insurance cap. Uninsured depositors are technically at risk because amounts above the limit are not automatically guaranteed. In smaller bank failures, uninsured depositors sometimes receive partial advance dividends, while the FDIC liquidates assets to determine final recovery amounts. However, recent history suggests that in systemic crises regulators may extend broader protection. During the Silicon Valley Bank collapse, federal authorities invoked a systemic risk exception to guarantee even uninsured deposits in order to prevent contagion. Whether that would happen in a JPMorgan scenario depends on political, economic, and systemic considerations, but given the bank's scale, regulators would likely act aggressively to prevent ripple effects across the financial system. Now consider your mortgage or auto loan. Many people mistakenly assume that if their bank fails, their debt disappears. In reality, loans are assets on a bank's balance sheet, meaning they are valuable contracts that can be sold or transferred. If JPMorgan collapsed, another institution would almost certainly acquire its loan portfolio. You would still owe the same balance under the same terms. Only the servicing institution would change. Payments would continue, statements would be reissued under a new name, and your contractual obligations would remain intact. Safe deposit boxes also raise concern during bank failures. While the contents of safe deposit boxes are not insured by the FDIC because they are not deposits, they are still legally your property. In a receivership process, access to safe deposit boxes is typically restored through the acquiring bank or bridge institution. There may be temporary administrative delays, but the assets inside remain yours. The bigger question that lingers in public imagination is whether a bank the size of JPMorgan would ever be allowed to fail outright. The phrase "too big to fail" emerged after 2008, when government bailouts were used to prevent collapse of systemically important financial institutions. Since then, regulatory reforms such as living wills require major banks to create detailed plans for orderly resolution in bankruptcy without taxpayer bailouts. These plans outline how assets would be unwound, subsidiaries separated, and critical functions preserved. In theory, this framework allows even the largest banks to fail without catastrophic disruption. In practice, political and economic realities would likely shape the outcome heavily. December 2025 reports about discrete Federal Reserve repo operations to major banks have added fresh fuel to public skepticism. When central banks provide liquidity through short-term lending facilities, critics sometimes interpret it as evidence of hidden instability. However, repo operations are also standard tools used to manage short-term liquidity fluctuations and stabilize money markets. The presence of such operations does not automatically signal imminent collapse, but it does remind observers that even the strongest institutions rely on central bank backstops during stress periods. If you personally hold less than $250,000 at JPMorgan in a single ownership category, historical precedent strongly suggests you would not lose money even in a worst-case scenario. If you hold more, diversification becomes critical. Financial planners often recommend spreading large cash balances across multiple insured institutions or using programs such as DARs, which distribute deposits among participating banks to extend FDIC coverage. Treasury bills, backed by the U.S. government, are another option for those seeking direct sovereign backing rather than bank insurance. It is also important to recognize the difference between stockholders and depositors. If JPMorgan's stock price collapsed to zero, shareholders would likely lose their investment entirely because equity holders are last in line during liquidation. Bondholders could take losses as well, depending on the resolution structure. Depositors, however, occupy a protected position under federal insurance frameworks. One of the most destabilizing elements of any bank failure is speed. Digital banking allows billions of dollars to move with a tap on a smartphone. Social media accelerates rumor cycles. In 2023, withdrawals at Silicon Valley Bank reached tens of billions in a single day. That velocity changes crisis dynamics dramatically compared to historical bank runs where customers physically lined up outside branches. For a megabank, regulators would likely intervene even earlier to prevent cascading withdrawals across institutions. Ultimately, if JPMorgan were to collapse tomorrow, your money's fate would depend less on the headline and more on your specific exposure. Insured deposits would almost certainly be protected. Uninsured deposits might be temporarily frozen but could be made whole under systemic risk exceptions. Loans would continue under new ownership. Safe deposit contents would remain yours. Stockholders would bear the brunt of losses. Markets would experience severe volatility, but the regulatory playbook exists precisely to prevent ordinary customers from financial annihilation. The fear is powerful because banks represent trust. When trust erodes, imagination fills the gap with worst-case scenarios. Yet the modern U.S. banking system is built around containment. That does not mean zero disruption, and it does not mean zero anxiety. It means that even in collapse, there is choreography behind-the-scenes designed to keep your debit card functioning while lawyers and regulators dismantle and reassemble trillion-dollar balance sheets over a weekend. The practical takeaway is less dramatic than the headline but far more empowering. Understand FDIC limits. Avoid concentrating uninsured cash in one institution. Recognize that debt obligations survive bank failures. And remember that in the hierarchy of financial casualties, ordinary insured depositors are at the top of the protection ladder, not the bottom. The collapse of a giant like JPMorgan would shake markets globally, but for most individual customers, the experience would likely be more administrative than apocalyptic. Now let's go deeper into the parts most people never think about, because this is where systemic risk, political reality, and human psychology all collide. If a bank the size of JPMorgan Chase were to collapse tomorrow, it would not simply be another bank failure added to a historical list. It would be a structural shock to the financial plumbing of the United States and, by extension, much of the global economy. JPMorgan is not just a retail bank holding checking accounts and mortgages. It is one of the largest custodians in the world, a dominant derivatives counterparty, a major clearer of treasury trades, and a core participant in global dollar funding markets. That means the consequences would ripple far beyond individual depositors and into pension funds, insurance companies, corporations, hedge funds, and even foreign central banks. Understanding that broader architecture helps explain why regulators treat megabanks differently from smaller regional institutions. When smaller banks fail, regulators typically step in after markets close on Friday, announce receivership over the weekend, and reopen branches Monday under a new institution or bridge bank. That model was visible during the 2023 collapse of Silicon Valley Bank, where liquidity stress triggered depositor panic and forced regulators into emergency action. Even though SVB was not small, it was nowhere near systemically dominant on the scale of JPMorgan. Yet its failure still required extraordinary measures to prevent contagion. Authorities invoked a systemic risk exception to guarantee uninsured deposits, signaling that when confidence is at risk, strict rules can bend quickly. That episode remains fresh in public memory, which is precisely why the hypothetical collapse of a far larger institution feels so emotionally charged. But here is the key distinction. JPMorgan is classified as a global systemically important bank, GSIB. That designation requires it to maintain significantly higher capital buffers, undergo annual stress testing, submit living wills outlining how it could be resolved in bankruptcy, and maintain liquidity coverage ratios designed to withstand severe funding shocks. In other words, regulators already assume that something catastrophic could happen, and they require the bank to prove year after year that it could survive it. These safeguards were built after the 2008 financial crisis, when institutions like Lehman Brothers collapsed and revealed how fragile interconnected markets had become. If JPMorgan were to experience a sudden crisis tomorrow, the first distinction regulators would analyze is whether the problem was liquidity or solvency. Liquidity problems mean the bank has assets but cannot access cash quickly enough to meet withdrawals. Solvency problems mean liabilities exceed assets, meaning the institution is fundamentally underwater. Liquidity crises can sometimes be solved with central bank lending, emergency facilities, or asset sales. Solvency crises require restructuring, recapitalization, or resolution. The difference matters because liquidity crises can be temporary confidence events, while solvency failures indicate deeper structural damage. In a liquidity panic scenario, the Federal Reserve could provide emergency lending against high-quality collateral, as it has done historically through discount windows and special facilities. During 2023 stress episodes, the Fed launched programs designed to prevent forced bond sales at unrealized losses. These tools exist precisely to stop a self-fulfilling bank run, where fear creates withdrawals that create failure. With a bank as large as JPMorgan, policymakers would almost certainly deploy every available liquidity mechanism before allowing a collapse to become irreversible. However, if we imagine a true insolvency scenario where massive trading losses, fraud, cyber catastrophe, or derivative mispricing erased capital buffers overnight, the conversation shifts toward resolution authority. After 2008, Congress created the Orderly Liquidation Authority under the Dodd-Frank Act, empowering regulators to place systemically important institutions into controlled resolution rather than chaotic bankruptcy. Instead of letting markets scramble the way they did during Lehman's failure, regulators would likely move swiftly to stabilize core operations while restructuring the holding company. From the perspective of an ordinary depositor with less than $250,000 in combined accounts, the experience would likely feel far less dramatic than the headlines suggest. The Federal Deposit Insurance Corporation would either transfer deposits to a new bridge bank or sell them to another institution. Debit cards would likely continue functioning within days, payroll direct deposits would resume, and insured balances would remain intact. Historically, insured depositors have not lost money in modern U.S. bank failures. The system is designed to prioritize them. For depositors holding more than $250,000 in a single ownership category, the situation becomes more nuanced. Uninsured balances technically carry risk, but recent precedent shows regulators may intervene to prevent systemic panic. During the SVB episode, authorities guaranteed all deposits, even those exceeding standard insurance caps, because letting large corporate balances evaporate would have destabilized payroll systems nationwide. Whether that protection would extend automatically to every large depositor in a JPMorgan scenario would depend on political calculus, contagion risk, and timing, but given the institution's systemic footprint, the probability of broad protection would be significant. Ultimately, the question, what happens to your money, is powerful because it triggers primal fear about security and control. Banking is built on trust. When trust wavers, withdrawals accelerate, headlines intensify, and social media amplifies uncertainty. Yet behind the scenes exists a structured regulatory framework built precisely to prevent catastrophic loss of ordinary deposits. The collapse of a megabank would be chaotic in markets, politically explosive in Washington, and globally destabilizing in the short term. But for the average insured depositor, it would likely be disruptive rather than ruinous. The more realistic scenario is not a sudden disappearance of your checking balance, but a turbulent weekend of emergency announcements, followed by a government-managed transition designed to keep ATMs functioning and payroll flowing. Markets might swing violently, shareholders would suffer, executives would face scrutiny, but your grocery money would not evaporate overnight. Fear spreads faster than balance sheet math. Understanding the mechanics turns a nightmare headline into a structured sequence of events. And that knowledge, more than anything, is what separates panic from preparation.